Good afternoon, everyone. It is 12 o'clock on my watch. Thank you for joining me. Much appreciated. By show of hands, three things. Can you see me? Can you hear me? And can you see the presentation? Perfect. Thank you very much. Much appreciated. All right, let's kick off. Interesting one today. Again, as usual, well, at least for me, today we're talking about the great active versus passive debate. A little bit of who we are. I think you've seen us before. Hopefully, you've heard about us, but we're proud of our achievements, and we hope to continue to deliver top class and award rated service to you going forward. From a services or what we do perspective, firstly on the right, there are some of our kind of partners that we use. Those are companies, etc., that we use to give you a hopefully a top rated or a top class financial product. Um, in terms of your needs and what we feel is the best of breed. Secondly, the next in line is the series that I just want to quickly talk about. So it's a little bit of a series, and I've termed it building intergenerational wealth. And I just wanted to take clients. Not necessarily on an expert level, but just slightly deeper in terms of how we think, why we think about it, and what we do on a daily basis for our clients. So the wealth series, we're on installment 5, if I can call it that. Firstly, we chatted about your will. We chatted about estate liquidity, then the art of asset allocation. A couple of these concepts that we discussed in the third installment, the art of asset allocation, will come through again today. But some of them I'm just going to touch on, and one or two concepts I'm going to delve slightly deeper into. Last time around, we had the great retirement annuity debate. Hopefully you enjoyed that. And then today we're talking obviously about active versus passive. The next one is all about offshore, which is a kind of a high level delve into offshore and what's on offer, what we think about them, where we see the world, and how specifically we approach clients and their funds and wealth around offshore. And then a little bit more technical is the last one, is a little bit around structuring. So we talk about taxes and which structures are the best in our opinion currently, and that we advise clients on. Okay, so that's the building intergenerational wealth series. You will see that we've started some of these we've covered before. Obviously, these aren't new concepts in the market. So some of these webinar topics we have covered before. I've presented on a couple of these previously, but this time around we kind of recording it, editing it, and putting it up on the YouTube channel, the Rand Swiss YouTube channel. So make sure when you look at when you want to come back to one or two of these concepts, or you miss out on one, you can always just click through to our YouTube channel and have a listen. Good. I want to start off by a quote or extract, and it's an interesting one. It says, "By now, you surely know that Wall Street quakes at the mere mention of indexes, who devour all in front of them. Active managers, many of whom have since moved on to careers as Walmart greeters or dental hygienists, are becoming as rare as the northern right rhinoceros." So obviously this is an extract from a Bloomberg article. it was a little bit tongue in cheek, hard to believe, but the writer actually had a more of an active slant in terms of the rest of the article. But I thought it was a good quote to start off with, to say, you know, you're here because you've heard this concept around passive versus active asset management or management, and you obviously have a feeling either way, and what you've heard up to now may have influenced that feeling, or that the reason why you're leaning one way or the other at the moment. But it is interesting that the rise of passive has been immense over the last, let's say, 10 years, and indeed a few active managers are are in trouble, like the northern white rhinoceros. But I think let's have a balanced debate around it today. What is on the agenda? Well, firstly, in terms of a goal, I just want to explore and possibly contribute to this active passive debate. I think you've heard a lot of things in the marketplace, and I have to just say here, if you want a deep dive technical conversation, this is for an average client, or pitched as an average or even above average client, but definitely not a mathematical wizard or a actuarial wizard that we're going to have this presentation on that level. So I would ideally like to contribute to the debate, and maybe leave you with one or two thoughts that may change the way you've been thinking about it previously, whichever way you are leaning towards at the moment. Next in line, or then what are on the agenda points, background, and some technical considerations. Unfortunately, we have to kind of, for some clients that go through some background and technical considerations. Other clients may have already gone through this, and it's old news. But I think just to get everybody on a level playing field, a couple of minutes on that. Then we're going to look at some of the arguments against, let's say, passive, and then against active, and we're just going to chat around them a little bit. There's two myths, which I termed myths. Whether that's the right or the wrong terminology, you can decide. But there are two kind of topics, if I have to label it differently, around this conversation that I think is often overlooked, that I think we need to just delve into for a few minutes on each of them, to understand when we look at active versus passive, and when we have this conversation. I think that should be top of mind. And then I'll end off just with some final thoughts. Good. Let's get then into the first point, which is the background and the technical considerations. Very top of the screen, the first bullet is defining passive. Now that's already a touch point, way up front, just defining what we're talking about in terms of passive. Because when you talk to certain people in the market, you have to understand what they mean when they say passive. This active passive debate, I often equate it to the Trump conversation. Whether you're pro or against Trump, you either fully engaged in being a pro-Trump supporter, or you're fully engaged in being a anti-Trump supporter. There's no green or a gray area. There's no middle ground in this world. You're either fully for it or fully against it. And up to now, or up to recently at least, I think the active and the passive debate is very much in that sphere of thinking. You either believe in passive and nothing else matters, or active, and that's what you believe in. So firstly, when we then define passive, I think let's just understand what we mean by passive. So you get the pure passive because everybody that's going to make a comment has a set of products or a thought process or whatever behind that statement. And we need to understand when they say passive, what sphere of passive is he or she talking about? Now, we get the true passive, right? So and I'm going to probably refer a lot to the top 40 today. So we get true passive. So when we say the top 40 index, for example, if you invest in it today, you get that kind of asset allocation behind each of the stocks, and each of them has a specific weighting in the top 40 index. And you kind of commit to that weighting, and that may go up and down as the stocks change a little bit, but that's purely passive. So you put money in there and you leave it for whatever your time period is. And I'm not even going to get into asset allocation and time periods, etc. today. So that is the purely passive way of thinking about passive investing. So you need to understand that when somebody mentions a passive investment, is that what they believe, or is that their definition of a passive investment? The second one then is smart beta. So all that smart beta is there's a little bit of a tweak in terms of some of the underlying methodology. And the easiest one always is to explain is to cap again, I'm going to continue with the top 40 example. Top 40, we all know, has been dominated in terms of weighting by NASPERS. It's obviously now changed into, NASPERS and process, and it's changed dynamics slightly, but historically and still today, NASPERS is a massive weighting in our index. So what happens, in China with regards to Tencent, you need to understand that that's a big driver in terms of our market, and I think it's roughly, let's say, 17% of our index. Now, a smart beta play, just to give you a little bit of an example, is to say, and we're going to continue with this example a little bit later, but let's say we cap any underlying stock in the top 40 at, let's say, 10%. So if there's one, and then there's usually one or two or maybe three that goes above 10%. If there's one or two of them that's above 10%, we're going to bring that weighting down. So let's say 17, and then we're just going to give it a 10% weighting, and then equally do that across the rest of the top 40 index. So that's a smart beta. So we've made a small adjustment in terms of the standard thinking of any, let's say, passive or index tracking fund. Smart beta. Okay. And you can do a lot of things. I've just chosen weighting in the index as one example, but there are many different forms of smart beta. The next one in line is then actively passive. So the next guy or girl you're going to chat to is going to tell you that they believe in passive investing, but when you understand the methodology or the mandate behind whatever they're talking about, it is by choosing a passive underlying instrument, let's say an ETF that tracks in the South African stock market, like the top 40 again. But they will jump. So then they will go to, let's say, out of the equity into a bond or overseas or whatever the case may be. So they are investing in passive vehicles, underlying instruments, but every now and again there's a change to what they believe is the next flavor of the month. Understand that and I'm terming that actively passive, because yes, they are choosing passive products, but the methodology or the allocation, asset allocation, whatever you want to call it, behind it is very active in its nature. And according to some definitions of active, you can then say, well, actually you're an active manager, not a passive manager. And then the last one is this core and satellite belief system, which a lot of market participants have out there, which is the core. So the let's say 50 or 60 or 70% of whatever, let's say it's a fund, right? Of this underlying instrument, 50, 60, 70% goes into the core of this fund. And let's carry on with my example. The core of this fund is the top 40 index, so the South African equity market, as an example. And that's the core that we have. But around it, the rest, so let's say it's a 70% core, that 30%, the satellite positions, is a little bit of a tactical asset allocation, which we'll talk about now. So I believe that for whatever reason, some negative comments coming out of China and what's allowed and what's not allowed these days. So let's underweight anything relating to a NASPERS, for example, in the top 40, and rather put whatever industrial index on top of it, or commodity play around it. So that satellite around the core we can play a little bit with, and we're hunting for a bit of alpha outperformance in the market on that basis. So just to recap this point, and I've belabored it a little bit, apologies for that, but what I just want to get across is understand when we talk about passive, what the definition of passive is, because there are quite a wide range of of beliefs behind passive, and to understand the argument around it, you have to understand the base of the argument, which is that person's definition of passive. The next thing I want to talk about just very quickly is top or quartile performance. In this case, top quartile performance. So as an asset manager, so if I'm a fund manager, let's say in an equity fund, I want to be top quartile all the time. All right, that's my goal. I want to be quartile is 25%, obviously. So I want to be in the top 25% of whatever I'm busy with. If I can stay in the top 25%, I've proven my worth, and I've probably outperformed the index, by a reasonable amount. And we're going to delve into that a little bit just now. But the point is top quartile performance. Now, sometimes, and again, there can be active mistakes that happens, and that's why I've stolen the next bullet point from the Art of Asset Allocation presentation that was a month or two ago, and very specifically, I just want to talk about these two very quickly. You get strategic asset allocation and you get a tactical asset allocation. So just to make it very simple, let's say my mandate says I need to play between a general equity and a property portfolio, 50% in this fund. So that's my strategic asset allocation. I got to that because whatever I did in the background, a lot of mathematics, and for some reason that model spat out the fact that I need to go 50% general equity, 50% general property, right? You can put anything in there. I'm just trying to give you an idea. And that's my strategic asset allocation, those two 50% components. Now, for whatever the reason is, world markets are under pressure, whatever, I believe that, valuations are too high, and I think it's now the season for property and not the season for equity. That's the next one then. So that was all strategic, 50-50, right? Now, tactically, I believe that we should see a little bit of a tilt towards property. So then I'm going to go tactically, for whatever reason, I'm going to go, let's say, 60% property and 40% equity. So strategically, I have a view of the world, but tactically, I can change that view over time. For specific reasons. Now, where it has gone wrong is a very big asset manager that you may or may not know. A couple of years ago, maybe 6, 7 years ago, I'm guessing, decided to exclude NASPers uh, out of the equity component. Now, NASPers, if you follow the markets for the last, I don't know, 12 years, I think 12 years ago on a trading desk, we had hot debates on whether it will break through 300 Rand. Um, you can go and have a look where Naspers plus processes now. But anyway, the point is they decided tactically, right, strategically, the top 40 was their benchmark. So they had to stick very close to that benchmark. And then tactically, you can make a little bit of changes to hopefully outperform the whatever your benchmark is. In this case, they made a tactical decision to exclude Naspers. For 3, 4 years in a row, they were bottom quartile and they lost flows like you cannot believe. And they tried to justify it for many years, and unfortunately, it didn't turn out too well, and they're kind of rebuilding trust with the market. But the point is, that's the difference between strategic and tactical, and understand that. I talk a lot more around asset allocation and how we think about it, countries, regions, classes, styles or factors, quality, value, momentum, subsectors, etc. in the art of asset allocation. So I don't want to stop there, but I just thought I'll bring the top quartile with the strategic and tactical conversation in here because I think it's a good building block if you didn't see that one. The last one on this screen then is the risk-adjusted performance. And we have these different measures. We have the Sharpe ratio, the Trenor ratio, the Jensen's alpha ratio. You don't have to worry about what specifically they do, but all that it is, or all that it means, it's a risk-adjusted returns. All right, so I get a return for Bitcoin. I know everybody loves to talk about Bitcoin, and I'm not going to indulge you and talk about it much more than just using it as an example. But the point is, Bitcoin gives you a certain return, right? And it's great, depending on where you went in. But you have to risk adjust that return to understand how it factors into the portfolio or the underlying set of instruments you have. So if Bitcoin has an amazing run and you have this massively good performance or return, but the risk associated to get that return, you could have just as well have had half of your money over this time period, then double your money. And take any other less topical conversation, gold, South African equities, South African property, whatever you want to do. The point is, when we talk about any of these investments, and you'll see this playing out going forward in the slide, we talk about so when you see Sharpe or Training or Jensen's Alpha, they have small tweaks, but the gist of it is risk-adjusted returns, and that's what we're after. We want to take the lowest amount of risk for the best amount of performance. And when we measure that in conjunction with everything else we're going to talk about today, it's important to understand risk-adjusted returns, specifically when we now look at a passive or an active investment. And that all should form part of the conversation. But we'll get back to it. Okay, good. So let's then move on to the second bullet point, which is, or agenda point, which is the arguments against active. Let's start there. So a couple of bullet points I put down there just to chat through very quickly. I'm not I don't think the point of this presentation is to dispel or to prove any of these. If we wanted to deep drill, this should be not a webinar, but a seminar for a couple of days with a lot of mathematicians and statisticians involved. But I thought let's talk about a couple of these arguments. So against active is what you'll hear in the market is it's luck, not skill. So if you've chosen a good fund or a stock or whatever you've chosen, whatever the underlying instruments are, and they did well for you, that is luck. It's not skill, it's not repeatable. So which brings me to the second bullet point. Winners don't repeat. So one of the big arguments against active investment is, yes, an active manager can be right for a season or a couple of years or a couple of quarters or whatever we're talking about. But in general, they can't be at the top of the pile forever. So winners don't repeat. They have a short lifespan in terms of being at the top of the pile. If you're watching Wimbledon, then it's interesting that those guys, at least those top three tennis players, can stay at the top. So those winners do repeat. But anyway, we'll drill a bit deeper into that later. Survivorship bias. All that means is once a bad, let's say it's a fund, let's say the underlying instrument is the equity fund. Once a bad fund drops off, so they've really performed badly, and they have a lot of outflows. The fund didn't do well, and clients decided to invest in different funds, and it becomes so small that it's not a viable fund anymore, and they close the fund. Then the underperformance kind of, in a lot of cases, falls out of when you look at the index, or the not the index, sorry, the weighted return of all active managers. So now this guy who's done minus 50 or 60 or 70% really bad returns, now suddenly gets out of the market, and only the survivor stays in. So you don't count that as a data point anymore, because it's not there anymore. It's not an active participant in the market. Therefore, the returns in whatever we're measuring now looks a little bit higher because the weak ones are busy dropping out all the time. So it's not a true reflection of returns, and that bias is termed the survivorship bias, one of the arguments against active. The next one is costs, and we'll stop a little bit later again at costs, and I have stopped. You would have seen here in one or two of the other webinars. But the point is, active management usually entails a higher cost structure. Now, many months or many years ago, that was a dramatic difference. I think, as you may or may not have noticed, that as time goes by, it is getting a little bit smaller in terms of its divergence between the costs of active and passive. But nonetheless, it's one of the arguments against. The extra cost, these extra costs that you pay, is it worth it? Do you get the added outperformance, the alpha, or don't you? The next one, very interesting one, is the big fund conundrum. Very relevant one as well. So what do I mean by the big fund conundrum? Well, what I'm doing here, and this is a couple of years old, I think it's worse now, much worse. But simply what we did here is we had a look at all the stocks on the all share index, in other words, all the stocks on the JSE, and we counted them. And we said, well, if there's 100 million fund and that fund cannot invest more than 5%, argument's sake, well, I think that is what we did here, cannot invest more than 5% in any specific company. So the company is X, has a size X, and we can't do more than 5% of X in any specific company. So the smaller companies obviously then fall out. That's basically what's happening here. So if we do that calculation and we say we have 100 million rand fund at that 5%, then there's roughly just over 170 funds that you can invest in, that was investable for this fund of the size of 100 million. Now, if we look at a much larger fund, and we have a couple of these mega funds in the country, you may know them well. But we have a couple of these mega funds in the country, and let's say it's 40 billion. So once we have that same methodology and we apply it to a 40 billion rand fund, you can only invest in roughly 35 shares. So suddenly your universe of shares and the universe of stocks that you can pick where you can generate this alpha or outperformance of the market is getting smaller and smaller and tougher. So the argument against active in this case is this big fund conundrum to say, you know what, the investable universe of a big fund is so small, and that 35 roughly funds in my example here, it's so small that we can, it's getting like, it's like the top 40, you know, for you know, to outperform the top 40 is going to be very hard when you only have 35 shares that's investable. All right, so that's the big fund conundrum. The next one is more volatility. So typically the belief is that active managers, because they chop and change and etc., there's more volatility in the fund. And the large percentage of constantly underperform funds, or let's not say funds, let's say investments or instruments. A large percentage of instruments constantly underperform the benchmark or the passive. Okay, so they say, and this one you would have heard probably 1,000 times if you've listened in the last couple of years, is that there's very few active funds that beat the benchmark or the passive index. And then the last big argument against is the CGT or the capital gains tax argument. Why? Because typically, if we go take a pure active, whatever the instrument is below, or set of instruments below, typically in a passive scenario, pure passive scenario, you buy it and you leave it, right, for 20 years or whatever your investment term is. In terms of an active fund, you're going to chop and change a lot. So you're going to realize these CGT events as you go along. Now, once you drill into how often you do that and what the magnitude is and how you manage CGT, and you, for example, depending on the size of, well, not depending on the size, you always have 40,000 Rand, the first 40,000 Rand of CGT that can be that is written off per annum, per financial year. So depending on the size of your portfolio, obviously you can manage that a little bit. And as you jump between funds or instruments or whatever the underlying is, you can kind of make sure you use that 40,000 Rand per year, especially if you have a 20-year term. Make sure you make use of that 40,000 Rand a year, because if you didn't use it this year, next year it's gone. So if you didn't, you could have realized the 40,000 Rand gain over 2 years, and then you have an 80,000 Rand CGT free payout. Whereas if you'd miss it a year, then you've lost that 40,000. So make sure you look at these things, you massage it correctly. Nonetheless, okay, those I think are a lot of arguments against active. There are more arguments against active, but I think let's leave it at that and go on to the next one. So my passive list is much shorter. The first one is flexibility and risk management strategies, and I think it. If I carry on with the top 40, it's a great example here. And it kind of encompasses the second bullet point, high concentration, as well. So what happens is, if I do not have flexibility, right? I'm in a top 40 tracker. I don't have any flexibility. China makes a few rumors, like if you go and open any news, financial news website today, you read all about it. But the point is, if there's some reason that I want flexibility, that I want to change anything underneath, it's tough in terms of passive. The counter argument is you don't want to ever change it, because that's what generates the outperformance. But again, we'll get there. So that's flexibility, and then the risk management strategy. Those two kind of go hand in hand for me. So if I see there's a risk coming from wherever, Asia, America, Europe, locally, commodities, property, whatever, it's harder to manage from a passive point of view unless you're actively passive. Remember that definition I had, which we can then argue, well, then you're actually an active manager. The second one, as I said, goes hand in hand. So I used the NASPERS example, which was, I think, NASPERS and Process together. Before they spun off, Process was about 20%, anything between 17 and a 20% allocation. So that's a massive concentration for one stock in the top 40 index. And you can generally not get rid of that unless you do a smart beta strategy. Remember, we spoke about that. So that concentration we can take from 17 to 10% in the example I gave you earlier. And that's then a smart beta strategy. And now the counter argument from the active guys will be, well, you just made an active asset allocation decision. So how passive are you? Okay. Anyway, I don't want to go down that just yet. The third one I have on here is that passive managers outperform in bull markets. So we've seen a massively long bull market run already, and if you go and look through the cycles, you'll see it. I should actually add a picture of the bull and bear market cycles here, and therefore, on the back of this bull market, you will hear that the passive proponents in our market is busy blowing the horn loudly to say, look how well we've done. And then the other side of the coin is, of course, in bear markets, typically the active managers perform better. Okay, so those are a bunch of the arguments. Some of them are very good and right on point. Some of them less. But let's go and look at some of these in a little bit deeper context. So again, I term this myths. You can probably use it, term it talking points, depending on which side of the fence you sit on. But the point is, I want to just talk through two myths, and the two myths, and I'm going to unpack each one in the following slides. Is firstly is the shotgun approach. So maybe there are some people on the call that don't know what a shotgun typically looks like, or what it looks like when a shotgun has when you've shot a bullet of a shotgun, but you get inside a shotgun, I think they call it bird, buck, and slug, the different types of little balls, like little marbles almost, inside these cartridges, bullets, call it. And a bird is like some small little bullets. So when you shoot, it sprays into like 1,000 different directions. So it's not like a bullet that one goes in. That's a slug, right? And bird or buck, sorry, that's bird. It's very small ones. The next size is buck. So when you shoot a shotgun with buck, there's about 7 or 8 or 10 bullets, depending on what size you have. And then you'll see 10 holes, but it's not all, centered around one little point. So the one myth I have, or the first myth I want to talk about, is this shotgun approach. And I'm going to qualify it a little bit further. Back about 10, 12 years ago, when I was still on a trading desk, I remember we had, every Monday, we had a little bit of fun. And we would bring in, and I don't even know if the Sunday papers still have on the back of it all the stocks on the JSE, but it used to have. So we would bring in that back page of the Sunday newspaper, put it on a kind of a dartboard, call it, and take a dart, and somebody would throw the dart at the Sunday back page newspaper with all the stocks on it. and that would hit the stock and whatever that was, APSA, for example. And then us as the traders on the desk each chose our stock for the week. So it was just a bit of fun from Monday to Thursday, and whoever, we all put some money in a pot, and there was a big pot, and whoever won the pot, would get the money, and if the dart won the pot, we would have a braai. We would go and buy whatever, everything, and have a braai outside in a couple of beers. So, you know, needless to say, where the story is going is the fact that that dart won way too many times. So actual guys that live and breathe the market got it wrong on a weekly basis. Now we understand a week is too short. There's too much volatility in the world to make any educated guesses guesses in a week. But the point is, the dart won a lot of times. So we obviously like that to a certain extent, because then we could have a nice Friday braai. Point is, that is one of the arguments in terms of against the active world that I want to term or want to classify as a myth, because it is not a shotgun approach. When we choose, or any active manager chooses any amount of underlying instruments and whatever we're talking about now, whether that's a fund of funds or an equity fund or whatever, it doesn't matter what you talk about. When an underlying active manager chooses an amount of, let's say, 10 different instruments underlying to a strategy, it's not a shotgun that gets pulled and 10 bullets go in different directions, or a dart goes in some direction, and some random underlying instrument is chosen. There is much more thought and reasoning behind it than the average. All right. So when we typically talk about the average, we are saying that, and that's going to lead into the next bullet point, we are saying that the average will remain that average, doesn't matter what you do underlying to it over a longer time period, or a medium to long term time period. So we're going to have a look at that. But that is what I'm saying, the shot, or what I'm terming the shotgun approach. The next one is this concept of what I term an infinitely unchangeable portfolio. And all that I'm trying to say here is, when we've shot the shotgun, or we threw the dart into the newspaper, back page of the newspaper, whatever we choose is never changeable. It's this infinitely unchangeable portfolio, and those are the two. So once I've chosen something, I do not have the mandate or the prerogative to change anything, to change my asset allocation, fund choice, instrument selection, whatever the case may be. And many times when these things are taken from now, passive versus active explanations, and you take it 20 years out from now to 20, whatever, a long time from now, it is on this principle of this infinite unchangeable portfolio. So if I did make a bad decision, I have to stick with it forever. All right, and it's always going to be a bad decision. So these two kind of myths, and we're going to unpack them now, here are the two myths that I would like to just address today, or talking points. I think we need to understand these 2 points in the bigger debate, being the great active passive debate. All right, so first one then is, I'll get to, sorry, I'll get right at the end, we'll get back to the shotgun approach. But let's just go through a few things. So firstly, this is a well-known player this is a screenshot of a presentation by a well-known player in the market. If you know this player, this screenshot rings a bell, I have nothing against it, nor it's just something I came across. It is quite old, so I decided, it conveys the message, and it's probably old data anyway. So let me use it. So this is how many active funds underperformed. You can see underperformed a passive index, and in this case, it's the S&P South Africa DSW, the Domestic Shareholder Weighted Index, right? That Standard and Poor's run. All that it's a little bit of a capped index. In other words, what I explained right at the beginning is no stock of the top 40 will be more than 10% in this index. So everything I've explained up to now in terms of that smart beta, that's roughly what they're doing here. They cap any instrument at 10% in this index. All right, so it's a good kind of passive benchmark, and what they did here is they said over 5 years, 93%, and let's just see, of what? Of South African equity funds, so normal general equity funds, have underperformed 93%. So only 6 point whatever percent outperformed this index over a 5 year period. Over a 3 year period looks worse, and over a 1 year period roughly the same. All right, so 96% over a 3 and 1 year period. Now that's bad. That's what you hear, and when you hear this, you think, okay, never touch an active manager. Why? Because my chance, that shotgun, when I shoot my shotgun, I have to hit one of these 4% or 3 or 6% of funds, these little gems all over the place. And that's going to be pure, hard work, if not impossible. Okay, that's one example. Here's another one. Again, a South African Quarterly Unit Trust Survey, again in 2017. Percentage of actively managed general equity unit trusts outperformed by the JSE. So again, over a 1 year period, they're saying that is the underperformance over a 3 year period and over a 5 year period. So this one is a little bit more generous. So over a 5 year period, this one was 6%. Here it's about 16%. So this one is a little bit more generous, and it's probably a little bit different underlying. And it's a bit old, but this is still what's being shown to you all the time. Now, this may or may not be wrong. I didn't go back to the 2017 data to verify this, but what I did do is I went and I looked at the current data. And by current, it's actually a year old. So the last time I updated these slides, so the names, and I actually want to, just like the art of asset allocation, sometimes I believe that you should blank out the names of the funds. But then I believe it will lose a little bit of credibility. So I always say, when you listen to me here, please don't look at this list. This is going up. You can send me an email after this. I'll send you the presentation. Then you have it in your inbox, and you can refer to this, every day, every moment, or every day. So don't look at the names and don't look at anything at the moment. Just listen to the concept or the principle that I'm trying to give to you. So firstly, this is about a year old. The last time I updated these slides was, I think, March roughly last year. And I decided not to, and this is, I think, now the second time I've done this presentation since then. And I've decided not to update these slides, not because I'm lazy, but because I just think, you've seen what the market has done since, the COVID pandemic started. And all that noise is just going to detract from the message. So up to here, more roughly March 2020, I think the world was largely what, if we may term it, if I may veer down the road and term it normal. in terms of returns in general equities. Uh, that being said, there are other arguments that would say, well, Jaco, you need to show us currently what happened, and I'm happy to do that. But and it will show the same, by the way. But the point is, I didn't want to, because you're going to see funny ups and downs, and I didn't want just to spoil the message with all the volatility we had the last year, because both active and passive had the same volatility. Anyway, back to this screenshot. So what I'm showing you here is, and you'll see here bottom of the screen, ZENG. So the South African General Equity unit trusts. Included in those, so the white background ones, those are normal active managers. You'll notice, you'll recognize 91, Fairtree, Signia, Blue Elf, some of them Sunlam, some of them you won't, Prudential, SPSG, Sasfin. You'll recognize all of these unit trust managers. The blue ones are passive, right? And then this DSW is the one we looked at earlier, remember? And then I just highlighted, that's also passive, by the way. I just made it a different color so you can see it. So it should be blue. And then the same here with the actual top 40 index. So what you can see is, all that you see here is the 1 year performance, and I've ranked it over 1 year. The 3-year performance ranked, 5-year performance ranked, and I just added the volatilities on all of these unit trusts. And we'll get back to that. What I then did is I said, if over a 1 year period, you are top quartile. Now, all these periods differ in terms of how many participants there are. There's just under, I forgot the exact numbers now, but there were just under 200 participants over a year. I think it was about 140 something over 3 years. And then guys with a 5-year track record was about just over 100. It's 110. Can't remember the exact number. Nonetheless, that's what I did here. So if they were top quartile, so whatever the number is times 0.25, that number, however many there are, I highlighted them. The top 25%, I highlighted green. So if it was a top quartile performer, highlighted green over 1 year, highlighted green over 3 years, highlighted green over 5 years. And there you can see the 5-year one again. Just for this slide, I obviously ranked or ordered the rank here, so you can clearly see what the top quartile is for over a 5-year period. Okay, so let me just make that practical. So the 91 value fund over a 1 year period was ranked 18th top quartile. Over a 3-year period, not. And look there, the actual return. And these are cumulative returns. The actual return was negative over a 3-year period. So if you gave this fund, which is a general equity fund, if you gave it money 3 years ago before this date, you would have had less than you started with. And then over a 5-year return, it's done really well, and it was ranked first. All right. So again, you see this volatility, right? And you can also see the volatility in terms of that 25%. Versus the DSW index that has about a 15% volatility. So much less volatile in this specific case. And just to give you a flavor of what I'm trying to get to. All right, so what you then look at here is over a 1, 3, and 5-year period, what did it look like in terms of active, in other words, the white background, versus passive, the blue background. So you can clearly see over a 5-year period, the best passive was the core share stock 50, and there you can see the return. Okay, so this return, I'm going to get to the costs later, but let me drop it in quickly here. This return is cumulatively 121 over the 5 years versus, any of these, take whatever, 36.1 BCI equity is 130. So over a 5-year period, you're going to have a very steep cost structure on and remember, this is after fees. So your other costs are going to have to be very steep to bring it down to even the best passive investment. That's just in this case. But what I wanted to get to here is, now that you understand, hopefully, the table, apologies if it's a bit too small, but what I want to get to is what we said on the previous slide. So over a 1-year period back in 2017, 92% of active funds underperformed the benchmark. In about a year ago, it was 20, so the reverse, let me say it the other way around. Over a 1-year period, 7% of funds, 7.7% of funds here, active general equity funds, outperformed the benchmark. And whatever benchmark you choose, I chose the DSW like they did. This was 21%. 21% is a lot more options that outperforms the benchmark over 1% 1-year period than 7%. Here it was 49% over the 3 years and 29% over the 5-year period. So there are 29% of active equity funds that outperform the benchmark at this point in time. So although I agree with the statement, so the statement is there are more the funds that underperform the benchmark than outperform the benchmark. I fully agree with that statement. However, what you generally see in the market is a bit too aggressive. 29% versus 6% 2 slides ago. What's it 5 years is 6.7%. There it is, 6.7% versus 29%. That's a massive or a big difference, and understand the difference. In terms of, and this is general equity. There are many different asset classes and underlying instruments. But I just wanted to bring this kind of home for you to understand the fact that you need to see it in relation to what it's doing currently. And then if I just added the top 40 there to continue the conversation, and you'll see it's a little bit different, but the point is there are many funds that outperform the benchmark or the passive ETF. All right. Then in terms of volatility, so forget this really small and bad example here on the right. Let's just look here on the left. The next one I did is I ranked by volatility from smallest to largest. And you can see in this case, interestingly enough, the Oasis and Crescent Equity Fund was a top quartile performer over a 1, 3, and a 5-year period, because you can see they're all green, right? The volatility is less than 10, right? Versus the DSW index volatility, which is less than 15. So that kind of expels one of the arguments. And I'm not saying this will happen in every single set of circumstances, every whatever category or subcategory or whatever we're looking at. But in general equity, over this time frame, we can see that there were plenty funds that had a much lower volatility than the benchmark. So I don't, in other words, I don't really always believe that the volatility argument is a valid argument. To just show you in the bigger scheme of things, this small one here, which you won't be able to read anything, I can't read anything either. But again, this is just a full list of what you see here on the left. So there, the yellow one is this yellow one that you see down here. That yellow one in the middle there, so that gives you an idea of the 15% volatility. So those are the ones you see. That's what the bottom of it is. So it's not quite in the middle. There are definitely more funds that are volatile, more volatile than the benchmark, than ones that are less volatile than the benchmark. But again, it's not. I would say it's inconclusive if I had to use a statistical term. Next one, can winners repeat? I'll let you answer the question. These are the best 5-year ranking. Do they still perform best? Look at the green ones in terms of top quartile. Are they still top quartile over a 3-year period? And are they still top quartile for the last year? So can winners repeat? So look, forget that one because forget the 91 value one for a second. So the fair trade equity precedent was 5, 2, 5, and 8. So over the last 5 periods, years, has been top quartile consistently. 36-1, Signia Active Equity, Blue Alpha, Resco. You can see. So the question is, can winners repeat? I'll let you answer the question. Final thoughts. I think, and we're at one already. Apologies for running a little bit over. So I'll run through the final thoughts very quickly. Understand that I think, in my opinion, the debate has matured. And where it hasn't, it should. It's no longer an active versus passive debate. I think if you're still stuck with a Trump hat or a non-Trump hat, in my earlier example, I think you're having the wrong conversation. I think we must, as an industry and as investors, move past the active versus passive debate and really look down underneath, under the hood. And I haven't even spoken about the risk-adjusted returns, etc. yet. We need to understand what's happening in the engine room of each of these funds, whether it's active or a passive fund. So what I'm trying to show you is that forget about whether it's an active or a passive fund. Let's look at certain criteria, and I'm not saying these criteria are the right ones, but just what I did here is I had a bit of a momentum play, right? And I said, let's have a 5, 3, and a 5, a 3, and a 1-year view, and I wanted something that's fairly not too volatile, and then let's choose from that. But the point is, there we can now say the core shares top 50 is a good player, or we have to consider it in our conversation. So all the other elements that we consider needs to be part of this conversation. Agreed, but just for my argument here is to say, forget about active versus passive. Let's say fund versus fund. For whatever reason, do we believe that core shares is volatility one of our main concerns? Then maybe we choose a core share above a fair trade equity precedent that's at a 25 vol versus a 16 vol. Then let's use the passive fund. Remember, the passive funds are the blue funds, right? So the fund versus not anymore active versus passive. Everybody gets rated on its own merit, and whether that's active or passive fund, according to whatever the underlying criteria is that rises to the top, that will get chosen. The next one is then, let's call about best of breed. And when I talk about best of breed for any of these underlying instruments, there's a number of things we're going to go through. So there's risk reward. Remember that, the Sharpe ratio, etc. Risk versus volatility. We need to understand that. That needs to be part of the thinking, whether it's active or passive. Alpha generation is obviously the alpha is part of the risk. So the bullet point 1 and 2 is kind of the same. The cost debate we already had a little bit, but we need to understand what are costs now, and do we get the alpha that the added alpha that we pay for, and the lesser cost. Because if we pay 1% cost, we better get 1% alpha over whatever our time period is. Otherwise, just go for the passive. And then factor of style and styles, I'm not going to drill into too deeply. I did that in the art of acetate education. So largely, I would say to end it off is the staunchly active or passive tone have softened, and I think it's time. And if it hasn't softened, I think it should. So hopefully, what I convey to you today is when you walk into anybody's office, when you open a news article and it's passive, 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 or active, active, active. I think you need to take one step back and consider some of these things we've spoken about today to say, well, if you're so staunchly passive or so staunchly active, uh, maybe there's one or two points you're missing in the conversation, or not, and then take it from that point of view. All right, I'm not going to say too much about our process. I can see I'm over time. Thank you for sharing an hour of your day with me. Really appreciate it. I look forward to having you at the next one, which is all about offshore. It's going to be, I think, in roughly 3 weeks' time. Have a look at our events calendar. I can't remember the exact date. If there are any questions, you have my email or any of our emails, just send it to me and give it, refer it to my attention, and I will get back to you. But thank you for your time today, and have a good afternoon. Bye bye.